In Australia, when a person dies, their assets become part of a deceased estate, managed according to the will or intestacy laws. The process begins with obtaining a death certificate from the state's or territory's registry office. If the deceased had a will, it outlines how their estate should be distributed. If not, intestacy laws apply. The appointed executor manages the estate and may need to apply for a grant of probate from the court. The executor must identify all assets owned by the deceased, including property, bank accounts, and personal items. The deceased estate pays outstanding debts, including funeral expenses, loans, and taxes owed. After debts are settled, remaining assets are distributed to beneficiaries according to the will or intestacy laws. Australia does not have an inheritance tax, but certain tax obligations arise during the administration of a deceased estate. The deceased's income and capital gains are taxed normally until the date of death. The executor lodges the final tax return. If the estate earns income after death, it may need to lodge deceased estate tax returns, taxed at concessional rates for 3 years. Generally, there is no CGT when assets are passed to beneficiaries, but it may apply if the estate sells assets to pay debts. Superannuation death benefits may be paid directly to a beneficiary or the deceased estate, depending on the nomination instructions. If the estate earns income after death, it must be reported in the deceased estate's tax return. The executor or administrator ensures all tax obligations are met, including lodging returns and paying outstanding taxes.